Ford's 2026 disaster wasn't one thing. It was everything happening at once. 11,000 employees laid off, an EV division hemorrhaging billions with no profitable exit in sight, a quality control system so broken the company had to reverse years of automation strategy, and recalls so massive they're reshaping how the industry thinks about software complexity. This is the story of how one of America's most iconic manufacturers walked into a perfect storm, and how every decision it made to prepare actually made things worse. The collapse started long before 2026. It started with a bet that Ford couldn't afford to lose. For over a decade, the automotive industry watched Tesla accelerate while traditional car makers struggled. The pressure was relentless. Investors demanded electrification. Governments mandated it. Competitors were already building factories. Ford looked at the landscape and made a calculation: get ahead of this wave or drown in it. They chose to drown on their own terms instead, or at least that's what the data suggests. In 2022, Ford launched a Model E, a dedicated electric vehicle division designed to separate the company's EV ambitions from its traditional internal combustion engine business. The theory was sound. Tesla's structure had worked. Why not mirror it? Model E would operate with startup-like agility, free from the constraints of Ford's legacy manufacturing and supply chains. It would innovate. It would dominate. It would prove Ford wasn't some dinosaur lumbering toward extinction. Instead, Model E became a black hole for capital, sucking in billions and returning losses that grew larger every quarter. By 2025, Model E had burned through enough cash to make investors genuinely uncomfortable. The company was losing money at scale on every EV it produced, not the kind of loss you see in the first couple of years of a new venture. These were the kind of losses that suggest something fundamental was wrong with the business model itself. And Ford's leadership knew it. They had to know it. The question was what to do about it. The numbers were staggering. For every EV Model E produced, the company was bleeding money through manufacturing inefficiency, supply chain problems, and development costs that weren't being absorbed by the vehicles actually selling. Battery costs didn't drop as fast as the industry projected. Consumer demand didn't accelerate the way analysts forecasted. Competitors entered the market with lower prices and comparable capabilities. Ford's EVs weren't bad vehicles. They just weren't selling in volumes that made the business model work. And when your entire strategy is built on volume, when you've made capital investments assuming you'll sell millions of units at improving margins, failure to reach those volumes becomes catastrophic. The answer, at first, looked like restructuring. Cut costs, streamline operations, move faster, cut more costs. By late 2025, Ford had already announced layoffs, thousands of positions eliminated. Then more announcements came. The numbers kept climbing. By the end of 2025, Ford had cut roughly 11,000 jobs in a single year. A startling number for a company trying to signal stability to markets already nervous about its EV transition. But here's what makes this story complicated. Those layoffs didn't solve the core problem. They were band-aids on a fracture. Model E was still hemorrhaging money. The company's 2026 outlook showed expected losses of $4 to $4.5 billion for the EV division alone. 4 billion, not thousand, billion. And the path to profitability wasn't 2025 or 2026, it was 2029. 3 years away, 3 years of losses at that scale, 3 years of shareholder pressure, 3 years of watching competitors gain ground. Ford's CFO, Sherry House, was blunt about it during earnings calls. The company expected about $1.6 billion in improvements from Gen 1 products, driven by lower U.S. volume and cost savings from restructuring. That sounded good until you did the math. They were saving $1.6 billion by producing fewer cars and cutting jobs. But they were spending $600 million more on Gen 2 development as they prepared to launch lower-cost models on their universal EV platform. The net was relief, but it was the relief of slowing the bleeding, not stopping it. And that's when the other disasters started revealing themselves. In 2024 and 2025, Ford made another strategic bet. They would lean on automation. Quality control had always been expensive. Rows of human inspectors on the factory floor, trained eyes catching defects that machines might miss. But machines were getting smarter. AI-powered vision systems could scan for anomalies in microseconds. They could be deployed at scale. They could catch defects faster than humans and without the pension obligations. So Ford invested heavily in AI-driven quality inspection systems. It wasn't just a cost-saving measure. It was presented as innovation. Progress. The future of manufacturing. This wasn't a reckless gamble. The technology was real. Computer vision systems had proven themselves in other industries. They could identify minute variations, catch inconsistencies, flag problems that would take human inspectors hours to spot. The efficiency gains were genuine. The cost savings were real. Financial analysts praised the strategy. It aligned with broader industry trends toward automation and AI. Every major automaker was investing in similar technologies. Ford was simply being realistic about where manufacturing was headed. Or so the narrative went. The results at first seemed promising. Defect rates dropped, or seemed to. The systems caught what they'd been trained to catch. When a component deviated from its design specification by measurable amounts, the AI flagged it. When a weld pattern looked different from the baseline, the system caught it. It worked exactly as advertised in controlled environments. The problem was that real manufacturing doesn't happen in controlled environments. Real manufacturing is chaos trying to organize itself. It's a supplier shipping material that's slightly off specification. It's a die in a press wearing unevenly, which means the components coming off, that die start drifting incrementally from design. It's the subtle sound a piece of equipment makes right before it fails catastrophically. It's the visual tells that come from decades of experience. The slightly wrong shimmer on a surface, the barely off color of welded metal, the timing of when a component slides into its receiver. These are the kinds of things that automated inspection systems are genuinely bad at catching. They can be trained on the exact defect that will destroy a vehicle's reliability. They can be tuned to catch the precise deviation that causes braking systems to fail. But pattern recognition, the kind that comes from years of hands-on experience with a specific production line, that's a different domain entirely. That's expertise. That's tacit knowledge. That's the thing that can't be easily coded or replicated. Ford discovered this the hard way. By mid-2026, the AI-driven quality control systems were missing defects. Not consistently, but regularly enough to matter. Vehicles were reaching customers with problems that should have been caught before they left the factory. The costs started adding up. Warranty claims, recalls, customer dissatisfaction. The exact problem that automation was supposed to solve was getting worse. In June 2026, Ford made a decision that shocked the industry. The company announced it was rehiring quality control specialists. Not a handful, 350 engineers. Some were former Ford employees who had been laid off in previous years. Others were pulled from suppliers. All of them shared the same qualification. They had spent years, sometimes decades, working on manufacturing floors, understanding the nuances of production systems, catching the kinds of defects that machines miss. Kumar Galhotra, Ford's chief operating officer, confirmed what everyone was thinking, but nobody wanted to say out loud. The automated systems had failed at their core mission. They could catch the defects they'd been trained to catch. They couldn't catch anything else. And in complex manufacturing, anything else is everything. This wasn't a quiet adjustment. This was a U-turn, a direct reversal of years of strategy. In the same month that AI had been blamed for the highest wave of job cuts in American history, 38,579 job losses attributed to AI in May 2026 alone, Ford was quietly paying premium rates to bring back the exact kind of human expertise it had spent years and millions trying to automate away. The timing couldn't have been worse, or better, depending on your perspective. Because while Ford was reversing its automation strategy, another disaster was building underneath the surface. A recall crisis so massive it was rewriting how the industry thought about software complexity. In 2025, Ford issued 153 separate recalls, 153. The previous record, held by General Motors, was 73. Ford didn't just break the record, Ford doubled it. Nearly 13 million vehicles were affected. Almost 1 in every 7 cars on the road was recalled that year. The scale was staggering. The headlines were brutal. The damage to consumer confidence was real and quantifiable. When a recall hits that scale, it stops being a quality issue and becomes a brand crisis. Customers start asking fundamental questions. Is this manufacturer trustworthy? Will this vehicle actually work reliably? Can I depend on this company to stand behind its products? These are the questions that drive purchase decisions. And once they're being asked publicly, once they're showing up in social media and consumer reviews, the damage extends far beyond the vehicles affected. It touches every model in the lineup. It makes prospective customers consider alternatives. It turns satisfied customers into skeptics. But 2025 was supposed to be the catastrophe. 2026 was supposed to be recovery. The company had acknowledged the problems. It had tightened processes. It had increased spending on quality. It had said all the right things. By June 2026, barely 6 months into the year, Ford had already recalled nearly 8 million vehicles across 34 separate campaigns. Another 2,633 vehicles were involved in additional recall campaigns. If the trend continued, if the number of recalls stayed on pace with the first half of 2026, the company would surpass even 2025's record by a significant margin. Some of these recalls involved hardware failures. There were braking issues. There were electrical gremlins. There were the kind of defects that used to dominate auto recalls and that could be fixed by replacement parts. But a growing percentage of the 2026 recalls involved something different: software. Over-the-air updates, corrections delivered remotely without requiring customers to visit dealerships. On the surface, this sounds efficient. Customers update their vehicles at home. No dealers involved. No lost time. No warranty costs tied to technician labor. Automakers loved it. They could push fixes remotely. They could patch security vulnerabilities. They could optimize performance. The economics were attractive. The problem was what it revealed about the complexity of modern vehicles. A trailer lighting malfunction that would have been a simple wiring issue in the 1990s was now a software problem requiring an over-the-air update. Towing functionality was controlled by software systems that needed patches. Brake behavior was increasingly dependent on code rather than hydraulic systems. The vehicle wasn't a mechanical device with electronic accessories. It had become a computer on wheels, and like all computers, it was susceptible to bugs. Ford wasn't unique in this respect. The entire industry had moved in the same direction, but the scale of Ford's recalls was uniquely harsh. And when you're recalling millions of vehicles multiple times in a single year, the over-the-air update model starts showing its limitations. Millions of vehicles need to connect to servers simultaneously. Software patches need to be tested across countless hardware configurations and vehicle variants. The risk of a software update causing problems instead of solving them increases with every recall. By 2026, Ford was managing this risk in real time, with millions of vehicles actively affected. The company had to keep track of which vehicles had received which updates. It had to manage customer frustration across dealerships and online platforms. It had to respond to media coverage that portrayed the brand as unreliable. And it had to do all of this while simultaneously dealing with the fallout from its automation strategy failure. What made this particularly difficult was that the recalls weren't isolated incidents, they were systematic. Multiple campaigns across different model years and powertrains, multiple systems, towing functions, braking components, lighting systems, all requiring fixes. The pattern that emerged wasn't one bad design decision, it was a symptom of organizational dysfunction. Vehicles were getting to market that shouldn't have gotten to market. Quality gates that should have caught these issues weren't functioning, and the automation systems that were supposed to prevent these exact scenarios were proving inadequate. Each recall generated enormous administrative burden. Dealerships had to manage customer communications. Customers had to schedule service appointments or wait for over-the-air updates to download. Ford had to track vehicle connectivity, manage update servers, handle cases where updates failed or caused new problems. The resources consumed by managing recalls at that scale are extraordinary. And those resources were resources that couldn't be allocated to developing new products, improving existing ones, or accelerating the EV transition that was supposedly the company's future. The connection between these disasters isn't abstract. Each one amplified the others. The EV division losses meant Ford had less capital to invest in quality improvements. The need to cut costs led to aggressive automation strategies that ultimately backfired. The quality control failures drove recalls. The recalls destroyed consumer confidence at precisely the moment when Ford needed customers to embrace its EV future. The layoffs meant fewer experienced engineers on the factory floor to catch problems before they became recalls. It was a cascade of compounding failures, each one creating conditions that made the next one more severe. And this is where the story gets genuinely revealing about what had changed at Ford. The company that used to employ armies of quality inspectors that prided itself on manufacturing excellence had decided to do more with less, not less capital, less people. The theory was simple. Technology could replace expertise. Machines could do what people did, but cheaper and faster. It was a seductive argument, especially for a company hemorrhaging money in its EV division. But the theory didn't account for the fact that manufacturing expertise isn't just rule-based knowledge. It's pattern recognition built through thousands of hours of experience. It's intuition calibrated by repeated exposure to how production systems behave. It's the kind of skill that takes years to develop and that can't be easily documented or transferred. You can code rules. You can train machines to recognize specific defects, but you can't easily code the accumulated experience of watching thousands of parts come off a production line and developing an intuition for when something is going to fail. Ford had believed it could. Ford had invested billions believing it could. Ford had laid off thousands believing it could. And then, in June 2026, Ford admitted it couldn't. The costs of this realization were enormous. First, there were the direct costs of rehiring experienced engineers at premium rates. These weren't entry-level positions. These were people with decades of expertise, and they commanded salaries and benefits that reflected their value. Ford was paying to undo years of cost reduction. Every dollar spent rehiring was a dollar that could have gone toward developing the next generation of EV platforms or funding product innovation. Second, there were the opportunity costs. The time spent dealing with the quality control crisis was time not spent solving the EV division's profitability problem. The focus required to manage recalls and rebuild relationships with suppliers was focus diverted from developing products customers actually wanted. Ford was fighting multiple fires simultaneously and losing ground on all of them. Third, there were the reputational costs. Consumers read headlines about recalls. They heard about a company that had bet on automation and lost. They saw a manufacturer struggling to produce vehicles that worked reliably. And they made buying decisions accordingly. In a market where alternatives exist, where Tesla, Chevrolet, Rivian, and traditional competitors all have functioning websites with new car inventories, being known as unreliable is catastrophic. The irony cuts deeper when you look at the broader context. Throughout 2026, Ford was simultaneously trying to convince customers to switch to electric vehicles. Come join the EV revolution, the marketing said. Leave behind fossil fuels. Embrace the future. But behind the scenes, the company was dealing with manufacturing disasters and quality control catastrophes. It was rehiring the expertise it had eliminated. It was managing recall campaigns at historic scale. It was bleeding billions on vehicles nobody wanted to buy. And meanwhile, the layoffs continued. Even as the company was rehiring quality engineers, it was announcing additional workforce reductions. Analysts projected another 8,000 to 11,000 positions could be affected in 2026 as Ford retools its plants for more flexible production. The math didn't work for employees, but Ford had to make it work somehow. Cut costs or fail. Those were the options. The question that nobody wanted to ask, but that everyone was thinking, was whether Ford's strategy had ever been sound in the first place. The company had looked at the future of transportation and decided it needed to completely reorganize itself to compete. It separated its EV business. It invested in automation. It reduced costs aggressively. It positioned itself as a company in transformation. But at every step, the decisions that made sense strategically turned out to be tactically disastrous. Separating Model E meant the EV division could operate with startup agility, but it also meant the division had no access to the scaled manufacturing expertise of Ford's legacy business. The company was building EVs without the institutional knowledge of how to build vehicles profitably at scale. Cost reduction meant improved margins on paper, but it meant eliminating the experienced engineers who could catch problems before they became catastrophes. Automation meant lower labor costs, but it meant replacing judgment with algorithms, and algorithms that turned out to be inadequate for the task. Every single decision made sense if you believed the theories. You believed in the power of market segmentation. You believed in the potential of AI and automation. You believed in the efficiency of lean manufacturing. But theories don't survive contact with reality. They especially don't survive when you're implementing all of them simultaneously, and you're dependent on each one working perfectly in concert with the others. By 2026, it was clear that Ford's transformation strategy had been built on sand, not because the individual components were wrong, but because the company had tried to execute all of them while also dealing with an EV market that wasn't developing the way anyone had predicted. Prices weren't dropping as fast as expected. Consumers weren't switching to EVs as enthusiastically as the model suggested. Competition was fiercer and more efficient than anticipated. And meanwhile, Ford was locked into a restructuring that had eliminated the flexibility to adapt. The broader lesson that Ford's disaster reveals is uncomfortable for the entire automotive industry. For decades, the conventional wisdom held that manufacturing excellence meant relentless efficiency. Eliminate waste, cut costs, reduce headcount, automate everything automatable. And for decades, this worked. Japanese manufacturers perfected it. American companies learned from them. The model was proven. But the model breaks when you're trying to accomplish two things simultaneously that are in tension with each other. On one hand, Ford was trying to transform itself into an EV company, a task that requires sustained investment, experimentation, willingness to fail, and rebuilding of expertise around new technologies. On the other hand, Ford was trying to reduce costs and improve efficiency through automation and workforce reduction. These two imperatives are in fundamental conflict when you're attempting to move into an entirely new domain of manufacturing. You can't automate your way to manufacturing expertise in electric vehicles when the expertise doesn't yet exist in your organization. You can't cut your way to competitive advantage when the cost you're cutting is embodied knowledge and experienced people. You can't separate your legacy business from your new business and expect the new business to spontaneously figure out how to build vehicles profitably at scale. Ford tried anyway, and by 2026, the cost of that decision was visible in recalls, in layoffs, in rehired engineers, in billions of dollars in EV losses, and in a manufacturing crisis that wasn't making headlines but was quietly reshaping the company from the inside out. The recall crisis of 2025 and 2026 wasn't really a quality problem. It was a symptom of a strategic problem. The company had made decisions, automated inspection systems, reduced headcount, separated EV division, aggressive cost-cutting, that seemed rational in the context of financial pressure. But those decisions had created an organization that couldn't actually manufacture vehicles at the level of quality the market expected. And there was no quick fix. You can't solve a systemic organizational failure by hiring back 350 engineers. You can't undo years of separation between divisions by memo. You can't restore institutional knowledge by offering premium salaries to people you laid off. Ford could manage the crisis. It could reduce the recall rate. It could restore consumer confidence, but it would take years. It would require sustained investment. It would require accepting losses while the company rebuilt the expertise it had eliminated. Which brings us to the fundamental question that Ford's 2026 disaster raises. Did the company walk into this storm blindly? Or did it walk in knowing the risks and choosing to anyway? The evidence suggests both. Ford's leadership clearly understood the pressure it faced. The EV transition was real. Competition was fierce. Traditional manufacturing was facing a genuine crisis. The company had to transform or face irrelevance, but the transformation strategy it chose, cost reduction through automation and headcount cuts, aggressive EV investment in a separated division, aggressive timeline to profitability, was a strategy built on optimistic assumptions about how quickly technology could replace expertise and how quickly the EV market would develop. When those assumptions didn't hold, when the EV market moved slower than expected, and when automation turned out to be inadequate for manufacturing quality at scale, Ford was locked into a strategy it couldn't pivot away from without admitting failure, so it doubled down. It cut more. It automated more. It pushed timelines more aggressively. Each of these decisions made sense individually. But together, they created a cascade of failures that by 2026 had resulted in the largest recall crisis in automotive history, the largest EV losses in the company's transformation, and a manufacturing crisis that required the company to reverse years of strategic decisions. This is Ford's 2026 disaster. Not one thing, everything at once. The layoffs and the recalls and the failed automation and the bleeding EV division all connected, all reinforcing each other, all pointing toward a company that had tried to transform itself faster than it was capable of transforming and had paid the price for that ambition. The question now is whether Ford can recover. The company is profitable in its legacy business. The F-150 still sells. The Bronco is successful. The company has capital and brand recognition, but it's lost years in the EV transition. It's lost credibility with consumers around quality. It's lost the expertise it spent decades building. And it's facing a competitive landscape where Tesla, Chinese EV manufacturers, and revitalized traditional competitors are all moving faster and more efficiently. Recovery is theoretically possible. Ford could return to profitability. It could rebuild consumer trust by demonstrating sustained commitment to quality. It could eventually catch up in the EV space, particularly as the market matures and the window for first-mover advantage closes. But recovery will require years. It will require sustained investment when the company would prefer to return capital to shareholders. It will require accepting that the timeline to EV profitability extends even further, not 2029, but possibly into the 2030s. And it will require acknowledging that the transformation strategy of the early 2020s was fundamentally flawed. Ford's 2026 disaster is a case study in how good strategy can become catastrophic when execution fails. The company saw the future correctly. It identified the need to transform, but it chose a path of transformation that required everything to work perfectly, that required automation to replace expertise, that required separated EV divisions to achieve economies of scale, that required aggressive cost-cutting to fund aggressive investment. When one component failed, the whole system started collapsing. For other automakers watching, the lesson is stark. Transformation is not optional in a world moving toward electrification, but transformation cannot be powered by cost-cutting and efficiency measures alone. It requires sustained investment. It requires patience. It requires accepting that the path to profitability in new domains extends well beyond what financial models optimistically project. It requires maintaining the institutional knowledge and experienced people who know how to build vehicles reliably, even while building entirely new products in entirely new categories. By the time Ford realized the failure was systemic, it had already incurred the costs. The layoffs were done. The manufacturing systems were automated. The expertise was gone. The EV losses were accumulating. All that was left was the slow, expensive work of rebuilding what had been dismantled and learning lessons that the industry should have understood all along. Manufacturing excellence can't be automated away, expertise can't be easily replaced, and transformation is always more expensive and slower than strategy documents suggest.